Welcome to this session. In this session, we are going to discuss the liability part of Fed's balance sheet, and subsequently we are going to see how changes in Fed's balance sheet, that means when central bank change components in their assets and liabilities, and how does it going to affect the money supply. Coming to the liabilities part, Fed's liabilities are mainly two components are there, two aspect components of the liabilities of the Fed are, one is currency in circulation and second one is reserves. This is also called as monetary base and also called as high powered money, and the definition that we have given earlier was by defining it as M0 money. So, that means the monetary liabilities is equal to currency in circulation and reserves. So, let us discuss this one by one. Currency in circulation means the amount of currency in the hands of the public. That is the amount of currency in the hands of the public, that is called currency in circulation. So, please note that currency held by depository institution is also a liability of the Fed, but it is counted as part of the reserve, not part of the currency in circulations, right. So, that means the currency held by the banking system is not included in currency in circulation, but it is a liability, we are going to include it in reserves. And coming to the second component, that is reserves. Reserves means currency held by depository institutions at hand and held in Fed's account as reserves. So, it is a liability of the Fed, but is counted as part of reserves. So, to summarize this one, in the Fed's balance sheet, what we can see here is that the liabilities are, one is currency in circulation, then second one is reserves, that means currency held by depository institutions and as well as at hand as well as held in Fed's account, both are considered as reserve. Total reserves, we can divide it into two categories. Total reserve we can make it to two category. One is called required reserve and the second one is called excess reserve. So, coming to the required reserve means of the total demand deposits and time deposit, that means the total demand and time liabilities, because the deposits are anyway liabilities for the banking system. So, the a fraction of the total demand and time deposit has to be kept with the central banking system, central bank, as required reserve. This is mandatory. For example, in India, you know that is approximately 4%, because it change often when central bank announce monetary policy. So, that means here the required reserve means a certain fraction of the total deposit, total fraction of the total deposits kept with the central banking system, right. That is the required reserve. And in addition to that, banking system also keep additional money in their reserve bank account. That means any additional reserve the bank choose to hold, be it with the Fed account or be it with the at their own vault, that means vault cash. This is called excess reserve. So, totally we are going to make the total reserve is equal to required reserve and excess reserve. Both are considered as reserve in our definition. So, look at this figure. What we can see here is that in the bottom part, you can see that at any given period of time, this part, this much is the currency in circulation, and the remaining, this one is this much is the reserves. That means reserve means including required reserve and excess reserve, and this both we are going to say that the high powered money. So, the high powered money, that means currency in circulation and reserve, that the required reserve and excess reserve, and this is we are going to call it as the monetary base, and also going to call it as the high powered money, right. This is the high powered money. So, what we are going to see that based on this, when we include the money supply definition, we have given that currency in circulation plus deposits, including all deposits, that including demand deposit and time deposits, that is money supply. So, this is the money supply is here, that means currency in circulation, that actually same, the amount is same, but the deposit we can see that it consists of a larger components. So, based on this monetary base, actually we are going to say that a central bank can control the monetary base in fact. So, the Fed's control over the monetary base is the main route through which it determines the money supply, that means this part. So, you can see that this is the smaller component, this is the based on this the Fed is able to increase the money supply to this much. So, this is the main route. So, what we are going to focus here is that mainly on the monetary base when we discuss the function or function of central bank or the process through which they increase the money supply. So, mainly through the monetary base, that is the main route through which it determines the money supply. So, later on we are going to see that using this much monetary base, this MB, they are able to, the central bank, and again not only the central bank, the stakeholders that we just mentioned in the previous session, that is the banking system, depositors and borrowers, they were able to increase the monetary base to this much, that this is a larger component, that the money stock, they were able to attain it. That process we will decline in we will discuss in one of the forthcoming session. So, let us now focus on this monetary base, this part, and also before moving further, let me also show you the money supply in India, what are the components included there. So, we can say that currency with the public is actually in that 14.7%, this one in March 2022. March 2022. So, you can see that this is the currency with the public, that is in the money supply we can see that the C component consists of approximately 15%. So, the remaining 85%, that means demand deposits with the bank, that consists 8.1%, time deposit, that also part of money supply definition, that is consist of approximately 75%, and the 0.2%, this is called other deposits by with the RBI. It is mainly done by Prime Minister, ex-Prime Minister, governors, etc., and also the government as well with the central bank. This is called other deposit with the RBI. So, you can see from here itself, currency actually constitute only 15% of the total money supply. All the remaining part is mainly by deposits, by that is demand deposit, time deposits and other deposits with the RBI. So, from the balance sheet, what we can see that in the Fed assets, that means government securities and discount loans, you can see that both earn interest income, right. When from the government securities which is being held by the central bank, you know that periodically they will be getting interest income on that. Then second one is when they lend to the commercial bank, the banking system, they are also getting interest income. Fed's liabilities are mainly currency in circulation, that is the currency, the printing of currency, and the reserves, that is also liability, that is money held by banking system with the central bank as required reserve and excess reserve. So, you can see that practically it costs nothing, though there are some minting cost, that means currency minting cost, printing cost is there, that currency minting it involves some cost, its distribution involves some nominal cost, and maintaining reserve that also involves some nominal cost, but in overall as compared to the income that they are earning, that is through these assets, it actually cost nothing. We can say that is cost very meager amount. So, in that way central banks can earn huge profit, central bank can earns huge profit from their operations. So, let us now proceed by using since you are now familiar with the what are the key components of a central bank's asset side and the liability side. Let us now see when central bank using open market operations, that is buying and selling government securities, how does it affect the balance sheet of the bank and commercial bank, and then what are the impact on the monetary base and the money supply of open market operation. So in this session we will mainly focus on the monetary base only to see how does open market operation change the monetary base. So let us start. For example, suppose that Fed purchases $100 of bonds, that is government securities, from a bank and pays for them with a $100 check. So what are the resulting changes in the T account? So we can see that in the banking system, we can see that their securities, the amount of deposit securities has declined by $100. Then you know that when this one is transferred to the Fed, they will be credited, central bank, the Fed will be crediting in the accounts of the banking system with $100, maybe through check, it does not matter, through check, suppose if they credit it. And what we can see that the banking system, immediately there is an increase in the reserve of the banking system by $100. How about the Federal Reserve System? And you can see that Federal Reserve System assets has increased by $100. When they are getting this asset, they have to credit $100 in the account of the the bank who sold this security to the Fed. That means they have to credit it, that the liability of the Federal Reserve System is increased by $100. So let us see the net result here is that the reserves have increased by $100. That means through an open market operation, that is open market purchase from a bank, the net result that in the banking systems the reserves have increased by $100. And about the currency in circulation, we can see that there is no change in currency in circulation immediately after that. So what is monetary base? Monetary base, we already seen that monetary base means C plus reserve, C plus reserve with the banking system. So in the monetary base, we see that there is no change in currency in circulation, but the reserve, this has increased. So you can see that as a result of this open market purchase, the monetary base has risen by $100, right. That is the first impact, that the impact of open market purchase in the banking system. The reserve of the banking system has risen by $100. Let us see that two cases, let us discuss two cases of open market purchase. One, open market purchase from non-bank public, that is the general public. Assume that a person or a corporation sells $100 of bonds to the Fed and deposit the check in a local bank. So how does it affect the non-bank public balance sheet? Suppose the corporations, you can see that their securities have declined by $100 and checkable deposits, it will be increased by $100. That means when the Fed issue a check and this check has been deposited in a bank, then you know that bank will be crediting this check, the amount of this that $100 immediately in the account of the depositor, that means in the form of a checkable deposit. That means non-bank public checkable deposit has increased by $100. Then about the banking system, and you can see that immediately when the general public or suppose the corporation deposit this money in the banking system, this check will be presented to the Federal Reserve System, central bank. So central bank will be crediting this $100 in the account of this banking system. Then you can see that immediately this crediting means nothing but increase in the reserve, that the reserve of the banking system increases by $100. At the same time, liabilities, you know that this amount this bank already credited in the account of the as checkable deposit in the account of the depositor. So that is checkable deposit also increases. So in the banking system, assets increase by $100 and liability increase by $100. What about the Federal Reserve System? So, you can see that Federal Reserve System security increase, that the assets increase by $100 and the liability also increased by $100. So, what is the net outcome? You can see that the net result here is that reserves have increased by $100 but no changes in currency here. And again, what we have seen in the previous discussion, similar to that previous slide, similar to that, the monetary base has increased by $100. So, later on you are going to see, we are going to discuss the monetary base is going to play a crucial role in increase in determining the money supply, right. So, because monetary base is the main tool or route through which a central bank can influence the money supply in an economy. So, in this open market purchase from non-bank public, what we have seen that there is again through this process, the process that we discuss here, monetary base has increased, but there is no change in the currency. Let us see another case. Case 2, again open market purchase from non-general public, but here the person selling the bonds or the corporation selling the bonds cashes the Fed check either at a local bank or at the Fed for currency immediately. They are not keeping it this proceeds from the selling of this bond in the form of deposit. Instead, they just cash it out, and you can just see that non-bank public, the securities have declined by $100 and currency has increased by $100. And what about the Federal Reserve System? We can see that securities have increased, that means asset has increased, at the same time liabilities also increased. Assets and liabilities both have increased by $100. Here we can see that now reserve, there is no net effect, is that there is no change in the reserve, because reserve is because it is not going through the banking system, they are not keeping it there at all. So, we can see that there is no reserves, reserves are unchanged, because here we say that the seller of this bond immediately cashed it, right. They are not keeping it as a checkable deposit with the banking system. So, currency in circulation has increased by $100 and the monetary base, as we mentioned here, C plus R, what we have seen here is that the R remaining constant, but currency in circulation has increased, thereby the monetary base also increased by $100. So, from here the summary what we can make here is that in both process, in first process the reserve increase, if it is done by deposited in a bank, reserve increase. If it is instead of depositing in a bank, if the seller of the bond immediately cash it out, make it as convert into cash, then the currency in circulation increase. So, what we are going to say that in both process, be it whether person selling the bond deposit the check in a bank or person selling the bond to the bank, to the Fed, cashes the Fed check either at a local bank or Fed for a currency. In both cases, what we are going to see that MB, that is C plus R, in one process, first process we can see R has increased, in second case we can see currency has increased. In both process, either it does not matter actually, but because the monetary base increase in the same amount, does not matter whether is they are depositing in a bank or cashing, taking the cashes the proceeds. So, net outcome is that monetary base increases. So, this is the summary we can do, that the open market purchase, the effects of open market purchase on reserves depends on whether the seller of the bonds keep the proceeds from the sale in currency or in deposits. If the proceeds from the sale are kept in currency, open market operation purchase has no effect on reserve, that is one point. And if the proceeds are kept as deposits, then the reserves increase by the amount of the open market purchase. So, the effect of open market operation purchase on the MB, however, is always the same. That means MB increases by the amount of the purchase, whether the seller of the bonds keep the proceeds in deposits or in currency. So, to summarize, the impact of an open market operations purchase on reserves is much more uncertain than its impact on MB. So, now let us see shifts from deposits into currency. Suppose that a person decides to close her or his account by withdrawing his or her 100 balance in cash and was never to deposit it in a bank again. Suppose expanding this idea that the banking habit of the people, there is a decline in the banking habit of the people. Then let us see if that happens, that means people withdraw their money from the banking system. Then suppose the bank, in this case you can see that banking system loses $100 of deposits and hence $100 of reserves as well. So, the main point here is, the key point here is that even if there is a shift from deposits into currency, the monetary base is unaffected by persons' disgust at the banking system. So, shift from deposit into currency, let us see how does it affect monetary base. Non-bank public is clear that the checkable deposits decline, that means currency in circulation increases, right. That means in the money supply we can see that a deposit component declines and C component, that the currency component increases. In the banking system, what you can see that reserves have declined, there is a decline in the reserve as well as there is a decline in the checkable deposits. In the Federal Reserve System, what we can see here is that currency in circulation, because when the checkable deposits are withdrawn, the reserves have declined by $100, but we can see that currency in circulation has increased. So, in this case also again our MB definition is C plus R. So, we can see that though reserves have declined, but C has increased. So, the monetary base remaining unaffected. So, the reserve declined by $100, but currency in circulation increased by $100 here. So, in summary we can say that monetary base is unaffected. This is one aspect, that the open market operation, that is one aspect of its liability side, and second one is discounting of loans by the central bank. So, what is meant by discounting of loans? That is a borrowing window, that means the discounting window, that is direct loan to commercial banks without collaterals. So, in practice mainly long term, it is considered as long term loans to commercial banks by the RBI at a discount rate. So, this is actually mainly done as a lender of last resort role. And coming to non-banking financial institution, they are not allowed to use this discount window, but can participate in the open market operation with the government securities. So, let us now discuss how making a discount loan to a bank affect the monetary base. So, here we are going to discuss how making a discount loan may affect the T account of banking system and Federal Reserve System and its subsequent impact on the monetary base. So, when the Fed makes a $100 discount loan to one commercial bank, let us call it as First National Bank, just to give a commercial bank, the name is First National Bank, let us call it like that. And then how the proceeds, how does it affect the balance sheet. So, you know that the bank is credited with $100 of reserves from the proceeds of the loan. So, that means putting in another words, when the Federal Reserve System or the central bank makes a loan to the commercial bank, the proceeds will be immediately credited with the commercial bank in the form of reserve. That means in the banking system you can see that the reserve will be increased by $100, that the asset of the banking system increased by $100, but the liability also increase, that means a discount of loan because is borrowing from Fed, it also increase. So, about the Federal Reserve System, you can see that the monetary liabilities of the Federal Reserve System have increased by $100 in the form of reserves, and the asset also increased because it has given a loan of $100 to the banking system. So here we can see that the monetary base, when a central bank give discount loan to commercial bank, the immediate impact is that the monetary base increases, that means increased by $100. So this is the one effect. So that similar to open market operation, when a bank is giving a central bank is giving a loan through the discount window, borrowing window, then we can see that the monetary base is increasing, right. So anyway we have seen that discussed in a couple of minutes before. That means the main route through which a central bank can influence the money supply in an economy is through the monetary base. So this is the second route, that means second tool, that is discount loan, through which it can affect the monetary base. What if the commercial bank paying off a discount loan from the Fed? So what if it repay the loan? So if the bank pays off the loan from the Fed, thereby reducing its borrowing from the Fed by 100. So the net effect is that the monetary base, there is a reduction, right. So the monetary base, there is a reduction, that is the reserves declines and the asset also declines. So immediately the reserve, that is the monetary base here, it declines. About the banking system, you can say that the reserves have declined and the liabilities also declined. So to summarize here, these are the two tools now we have discussed. The one is open market operations and another one is discount loans. Then the third part is other factors affecting the monetary base. There are mainly two important items that affect monetary base, but they are not controlled by the Fed. So importantly, recall that open market operations and discount window, that actually central bank or the Federal Reserve can control, but there are two more other items that is not in the control of the Fed. One is called float. Float means when the Fed clears checks for banks, it often credits the amount of the check to a bank that has deposited it. It increases the bank's reserves, but only later debits it. That means decreases the reserve of the bank on which the check is drawn. Suppose for example, you have an account with the State Bank of India and you write a check to another person who is having an account with another bank. For example, you are having an account in the SBI and you write a check and you hand it over to a person or a company who is having account in another bank called HDFC. Then the proceed, how this transaction will happen. Who is the person who is getting this check will be immediately depositing this one with the RBI. Person who is getting this check, he will be depositing it with the HDFC and HDFC will be submitting it into the RBI, right. So the moment the person who get this check and deposit with the HDFC bank, immediately this money will be this much money will be credited into the account of this person who is depositing this money. That means for example, this one is $100, this one will be immediately credited to the account holder of HDFC, and immediately you can see that it won't be debited in the SBI account. That means SBI, the same amount of money will be there. So it will take some time, maybe a couple of minutes when they deposit it with the RBI, and RBI it will be deducting from SBI. It may take some couple of minutes or maybe hours. So that means until then this money, it is credited into the account of who deposited this money check with the HDFC, and it also you can see that this is yet to be deducted, that $100 is yet to be deducted from the account of SBI. So this amount, this is called float. That means resulting temporary net increase in the total amount of reserves in the banking system. So that means when RBI immediately crediting this money here as reserve, you can see that reserve is already there, but it is not deducted from SBI. You can see that there is a temporary net increase in the total amount of reserve in the banking system. So occurring from the Fed's check clearing process. This is called floating. So, it causes a rise in the reserves in the banking system, and thus the monetary base also rise. And second one is treasury deposits at the Federal Reserve. When the treasury moves deposit from commercial banks to its account at the Fed, lending to a rise in the treasury deposit at the Fed, it also causes a deposit outflow at these banks. So, when there is a deposit outflow, because when the government deposit their money at the Federal Reserve, when they move their money, their deposit from the commercial bank to the Federal Reserve system, so it causes a fall in the reserves in the banking system, and thus the monetary base also fall. So, importantly, we saw two things, one is float and another one is treasury deposit, movement in treasury deposits. So, both actually you can say that there is an impact in monetary base, but this change in monetary base is not at the hands of the Federal Reserve System, not with the central bank. So, what we have covered here is mainly how the Fed how through its operation, that the open market operation and discount window, we saw that it can influence the monetary base, but there are other factors which also affects monetary base, and which is but not in the control of the Federal Reserve System. Thank you for watching this video, and see you in the next session. Thank you.